Good day to one and all. This is Dr. Sivaraman of IKnowIndices.com. So I'll be presenting the webinar on my trading system. This is the fifth webinar in this particular series, which is given in commemoration of the 10th anniversary of FX Street. So today's topic I'm going to cover is market reading and the forecast. In the previous webinars, I've been discussing about how exactly the market is functioning and how the manipulators take control of the market, then besides the timings which are followed by that of the players, and also we have seen some of the constraints what you could face when we enter into the trading system. So in that process, first of all, we have to understand about the constraints and try to find a solutions for such constraints, then try to read the market and then decide upon the type of trades you intend to do, then the going will be very good. So before that, let us see how exactly the market could be read from time to time. That is, we are trying to derive from that of the market moves what the players are trying to do. So we are trying to read the operator intention. Then from there we have to derive the forecast, and that alone is going to help us in taking trading decisions. Simply making the market reading may not be able to help us. We need to derive the forecast from there, whether euro is going to firm up or it is going to drop. We should be able to find out. So accordingly, we can decide whether we can do a sell and buy trade or a buy and sell trade. So let us just review the topic. So I will be explaining some of the points or the limitations of the statistical techniques and also the technicals and the fundamentals, how exactly they alternate in the market. So one will not be in a position to find out whether technicals is going to dominate the market or a fundamental is going to dominate the market in next 2 hours. And that sort of uncertainty we tend to develop while entering into the market. So we need to find out what could be the possible simple market reading technique which can really explain to us the intentions of the players so that we'll be able to trade along with it of the players. So tracking the players' intentions from time to time is very important so that we'll be able to keep away from that of the herd mentality, and also we will not be under the grip of greed or panic, and we will focus only on our trades. So I want to explain with regard to the various technical analysis we try to use in our day-to-day analysis of the market. So invariably, when you go into that of the statistical analysis, we need to have the variables. The variables can be of two types, namely the fixed variables and the changing variables, or the dynamic variables. So the fixed variables like the time, which pass on with regular intervals, and it is not changing as 30 minutes, 1 hour and things like that. It changes at periodical intervals. So whereas the changing variables, namely the price action. So that is why we take the price action on the y-axis and the time scale on the x-axis and try to draw the charts and try to find out what could be the price action in future. But in this particular process, we can take the samples and treat them using various statistical analysis. When you try to pick up the samples, we can simply take into consideration every 30 minutes what is the average price, or some of the random picking of the price and methods of that nature, and we can try to understand how exactly the statistics can work on it. But we will be able to derive the statistics, but it may not be able to give the forecast actually. There will be a lot of limitations pertaining to that, because at every time we become subjective because we do not give into consideration. The time is also equally important when you are trying to constrain the changing variable, namely the price action. Then we will not be able to give any definite time frame, when we are doing that analysis of that nature. Okay, exactly by 8 GMT the market is going to drop, and then later on 8:30 GMT it is going to rise. We will not be able to give that sort of analysis. When you ignore totally the fixed variable, namely the timing, when you are taking into consideration the statistical analysis. Then also we try to deploy the moving average instead of the time factor, as simple moving average, weighted moving average, or exponential moving average, etc. And try to deploy it over the chart and try to see what could be the influence of the timing. And again, they are all nothing but the moving averages, and they are not the absolute values or the random samples. So invariably you find that we become subjective by applying that 20 days simple moving average, or 7 days moving average, or 200 days moving average, 100 days moving average, 50 days moving average. So according to our convenience, we try to use the different type of moving average, and we do not have any justification why I am using that. I find it comfortable. Probably it gives little more comfort when I am trying to project the market, but that is not the answer. But we have to find the exact time frame which is working on that particular market. Then only we will be able to derive the future from the other market. Similarly, when you are deriving the standard deviation, like a single standard deviation or a double standard deviation or a triple standard deviation as the absolute variables, when you are drawing the parabolic curves or the up and down moves of the market, and when you try to derive the standard deviation or the amount of deviation which are permitted on either side of the market, when you try to derive it, they are all hypothetical levels, and there is no necessity for the market to reach those levels. You won't be knowing whether they are really hypothetical levels or whether they can be really achieved in the market. And that is why you come across the standard deviation when you plot it. We also try to find out the pivot points where the turning points happen in the market. And when you try to derive the pivot points, there is no guarantee that the market can respect really the pivot points. And the pivot points also dynamically get changed from time to time when you take into consideration a larger spread of the market. When the spread of the market becomes lesser, then the pivot points become varied. When the spread becomes suddenly increased, the pivot point gets shifted. So you find really whether the market can respect such pivot points. Then you come across, that is why you come across a wide variety of pivot points and try to find out where exactly the market fits in. But you won't be knowing beforehand where exactly the market could fit in, and then it will make the reversal point. Then invariably when you draw the channels, we go in for a linear deviation or linear derivation. That is, we take the highest point and the lowest point on the upper side and the lower side and try to connect them and make it linear. And have you ever seen that market is making a linear move or a straight downward move or a straight upward move? Then you instead call it as a channel, and in between it moves. But actually the market is exhibiting the curvilinear mechanism. So we have to go in for a curvilinear analysis because you come across up and down moves. So you need to know within the channel also whether it is going to make an upward move now or a downward move. So ultimately that is the most important thing for us to make such understanding. Hence people go in for the MACD and the RSI and comparison, the convergence and the divergence. And whenever you come across the divergence happens, then the market is expected to reverse, etc. And also we get it confirmed with that of the RSI. Then invariably what happens? Sometimes the divergence becomes hidden divergence, sometimes it becomes exposed divergence, and sometimes it stays very briefly at that particular level, suddenly the market reverses. Then we go in for a parabolic curves and also try to understand how exactly the market is expected to bring in a curvilinear pattern. But in that particular process of curvilinear pattern, you find that it does not hold any consistency. There is no need that this particular 2 hours it has to make a downward move. After 3 hours it has to make an upward move. You will not be able to derive it. And simply we use those things because the formulae were available. They are all being incorporated in the charts. We try to incorporate all the type of analysis in the charts and just find out which one is going to work really for us. But really, you do not come across a consistency in explaining what could be the market move. You would have seen suddenly GBP made a drop from that of 1.55 area to that of 1.5450 area and suddenly jumped up and after the data. And will any of these statistical analysis will be able to say that after the data it is going to rise? Then immediately we say, no, we have to follow the fundamentals because there is a data released by 10 GMT. So obviously the market is going to follow the fundamentals. Okay. When the fundamental is being released, the data is being released. GBP has gone up. Then after about 15 minutes, you find that it comes back to 54.50. Then we will say because of the technical, the market has corrected. So according to our convenience, we use the technicals or the fundamentals alternatively, but we are not in a position to say that, okay, the next 2 hours the market is going to follow technical, or the next 2 hours the market is going to follow fundamentals. So this is still an uncertainty among all analysts, including me. So obviously we have to think of various other type of techniques like retracement or Fibonacci retracement. How exactly the market could retrace and then move up. There are various levels of Fibonacci levels of retracement, etc. 23.6, 32.38.2, 50% retracement, 61.8, all those things. But we won't be able to say, okay, whether it is going to stop with this particular retracement and go back, or 38.2 and then go back, or 50% retracement and reverse, or 61.8% and reverse, or more than that. And when it comes to 161.8, yeah, then we will say, okay, it has retraced up to 168. But what happened to 23, 38, 50, 61? It is simply breached. We expected them to be a support, but whereas the supports were not held, then immediately we say that support has turned out to be a resistance. Resistance has turned out to be a support. So we can use all those terminologies for whom we are trying to do that. We have to question ourselves. And are we successfully able to use them effectively in order to make effective trading in the market and consistently make money from the market? Then also we use the candlesticks. I'm not trying to criticize. These are all the limitations in the statistics, and people should be able to really work on it and apply the research approach to this and try to find appropriate solutions to this. Then candlestick variations you come across, you find there are various types of candlestick formations and also the Elliott waves, convergence and divergence. And these candlestick formation, according to our convenience, we try to use it as a 15 minutes and 30 minutes and things like that. In the candlestick, we define, okay, where exactly the price is making the higher level, the lower level, the opening and the closing, and the noise on the spike. And we won't be knowing what is the volume was used to make the noise. And we simply ignore that as a noise. But actually the players use a very big volume and try to create that particular noise. We try to ignore it when you go in for a candlestick analysis. Similarly, the Elliott's wave. So we try to derive the wave pattern, that A, B, C, D, E pattern. Then we try to find out, okay, this is the fourth one, this is the fifth one, and things like that. Suddenly we say that, okay, this is the second one. And it might be the third one, it might get extended, and probably we say suddenly that it has formed the fourth wave beforehand. Now, I was explaining with regard to the candlestick variations. We use the 15 minutes candle formation and 30 minutes candle formation or 4 hours candle formation. We try to take into consideration the closing price, the opening price of the candle, and you expect the candle to get closed. Then you find whether this particular candle is able to explain whether there could be an upward move or the downward move, the red candle formation in 3 successive conditions or a green candle formation in 3 successive conditions, and doji formation. All those things we can take into consideration, but you do not come across the consistency with regard to the candle and the derivation. Then we apply that moving averages over it. We apply that of the Elliott's wave, and we try to find out in RSI any convergence and the divergence happening. So we try to apply as many as analysis as possible, try to find out where exactly the market is heading. But without our understanding, you come across that the chart we try to expand or we try to compress by using different time frames, and that is referred as the skewness and the kurtosis. So when you increase the time frame like 4 hours or 1 day, then obviously the chart become compressed. And when the chart become compressed, you try to take the highest point in that particular chart, and you take the 15-minute chart or a 5-minute chart and try to take the highest point in that, you will come across the variations. You find with regard to that of the height as well as with regard to that of the breadth of the chart, you will find variations from that when you use different time frames. And we simply ignore it, and without understanding the impact of skewness and kurtosis. Because whenever there is a vertical expansion of the chart, it is something like when you are trying to get the image of a person and use our Adobe software and try to push it up and the down, then what happens? The face looks totally different. In the same way, we are trying to work on the chart. So if you try to work on the chart without understanding the chart structure is being altered, then we tend to give a wrong diagnosis to that. Then obviously that is not the way of doing statistics, because statistical analysis mainly meant for objective analysis. But we use so much subjectivity into our analysis because we do not know the fundamentals very strongly. So obviously we find, according to our convenience, we try to use the statistics without understanding the limitations of the statistics. There are various statistical methods which are to be applied to various conditions and various types of variables available and various types of samples we take into consideration. But we simply ignore all those things, the fundamentals of statistics, and without understanding the charts are being skewed and kurtosis happened, and finally you try to find out that I expected the market to go up, suddenly it went up and it has not even reached up to that of the resistance, it has dropped. Or it has gone above that of the resistance. I thought that resistance becomes support and suddenly the market dropped and the support becomes resistance again. So that sort of failures happen in our understanding of the market because we are exploiting the chart without understanding that what we are not supposed to do. Then there is another type of analysis, namely cluster analysis. Instead of taking into consideration the two sets of variables, we can take multiple variables, including the time frame, and try to do the cluster analysis and try to find out how exactly the time factor is also having an impact with regard to the market. Because depending upon that varied time factors, the market volume can vary. No? During the start of the session, the volume will be relatively good. During the mid-session, the volume might come down, and towards the close, probably most of the traders would have closed the positions and more fresh volumes may not come in. So you come across the variations with regard to the different time frames of the market, and we simply ignore such things and try to analyze it. There comes the limitation. Then the price range analysis, we try to do it depending upon the spread between the high and the low during different time frames. That is why therein the parabolic curves fit in. And when you are going for the variations with regard to the price band, you find that the price band oscillates very quickly. And in this particular oscillation, you try to derive what could be the next type of oscillation on the upside and the downside. Then you come across the limitation because you won't be knowing whether the downside is going to come first, later on the upside, or the upside is going to come first and later on the downside. So ultimately, by all these statistical analysis, we try to derive what could be the probable support and what could be the probable resistance. Ultimately, you derive it indirectly by various methods. So, near the support, we tend to buy it, or near the resistance, we try to sell it. But if you ask any of the technical analysts, including the analysts who do the trading, near the support, will you keep a limit order and buy? No. They will watch the market and try to see whether the support is held, only then they will try to take a position. Whenever there is a data release, they know very well that the market is going to bring in a volatility. It is not going to respect the technical analysis. Then they will try to look for the market stability before going for taking any position. So invariably, the amount of uncertainty will make you to keep away from the market. So ultimately, we have to get rid of that uncertainty. Only then we will be able to make decisive trading in the market. So when you try to find out the variable supports and the variable resistance, that is a mild support or a strong medium support, or the strong support and things like that, then we use the terminology of supports, but they don't act as real supports, because the players know very well, these technical analysts or the traders using technical analysis are trying to keep the stops below that of the support. So it is very easy for them to push the market downward using some technique and hit the stops. So invariably, when you try to follow these things and try to keep that stop below that of the support or above that of the resistance for a sell and buy trade, it becomes a hot cake for the players to go and hit the stops and earn all the money quickly. So we need to find out the dynamic support and the dynamic resistance from time to time. And there again, you come across the limitations because the volume has to be steady if you want to understand the dynamic supports and the resistance. When the volume is varying from time to time, which is also going to have a limitations with regard to the market. Deriving the forecast. Then you come across the technicals and the fundamentals alternate in the market. Which one is going to follow the next? We need to identify. So basically the fundamental analysis like producer price index, non-farm payroll, the GDP, consumer price index, unemployment claim, consumer sentiments, inflation, interest rate disparity between the countries because of the currency move from one country to another country. Besides, the speeches of various people like a hawkish tone and a dovish tone and things like that. So how can you quantify all those things? Okay. For non-farm payroll, we'll be able to see about 50 pips rise or a 50 pips drop. Okay, if that non-farm payroll is going to be negative, can we expect an upward move in euro or a downward move in euro? Upward move can happen as a USD weakening move or a downward move can happen as a risk aversion move. So when both the possibilities are there, then how exactly you are going to use this effectively? Then invariably you try to allow the market to settle down for about 30 minutes and see what could be the next move in the market and try to take the position, but market may not move afterwards. So obviously we try to look into the volatility as a scaring market rather than looking at that volatility as a trading opportunity. So we need to find out whether a technical or a fundamental to dominate the market in the time frame in which you intend to take the position and close the position. And the players are creating the market sentiment to act against based on the fundamentals because they derive various types of interpretations and try to spread it using the media. I explained elaborately how exactly it changes. So which one dominate next? We need to identify. So we can follow the technicals or the fundamentals, but you won't be knowing which one is going to dominate in the market. At that particular time frame, I want to enter into the market and exit. So it is extremely difficult to decide on that. Then you have to question one thing. Can the economic conditions be measured in terms of pips? Whether it is non-farm payroll or any data release or consumer price index or whatever it is, will you be able to quantify the pip variations from time to time? It depends upon the volume. The volume of short sellers are there in the market more, then suddenly you come across a spike of about 150 pips. Then if the volume, the traders have not taken into consideration or the traders are not willing to take the position before the non-farm payroll or before that interest rate announcement, then you find that market looks lackluster after the data release. So will you be able to gauge it in terms of pips? What is going to be the next move after that? So when the data is released, you expect after that the market to show some activity. But if the traders are not taking the positions, the market is not showing activity, and after about 30 minutes or 1 hour, or probably for a minor data release or for a speech, the market becomes more active. Sometimes you come across after the data release, the market is subdued, suddenly the rumor is released, and then market brings in unexpected move. So how exactly we can determine those things? When exactly they are going to use the rumor? Will anybody able to say? No. So with uncertainty of this nature, how exactly we can derive the forecast? Then the USD dominant, other majors dominant. Why crosses be more volatile than the majors? If you ask the question, when you are talking about the fundamentals and the technicals, you know that, okay, US data is weak, so USD is going to correct, or that other majors data is very positive, so other majors are going to gain, so we can say this. But the crosses becomes more volatile when compared to the other majors. And suddenly you come across GDP data is released, then, the GBP data is released, then GBP goes up, all other currencies are held during the mid-session, then you find the crosses are handled very heavily. And today, for example, I was explaining during the Asian session live market analysis between 5 and 5:30 GMT. That Euro, they were showing the positive net change, and also USD CHF, they showed the positive net change. And then we come across still also in the live market foot page, Euro is showing a positive net change of 14 pips, and CHF is showing a positive net change of 98 pips. So when Euro is gaining, obviously that is USD weakening move, CHF is also expected to drop, USD CHF is expected to drop and show that USD weakening move. Instead it is showing USD gaining move. As a result, you come across Euro CHF as gained about 142 pips. This I gave the forecast during the Asian session that they wanted to make the big gain in the case of Euro CHF. So we will be able to derive the market, the majors or the crosses, based on the intentions, or it is advisable to follow the technicals and the fundamentals and expect which one to take the market in order to retain the sentiment for a few hours. So in a simple market reading technique, identify the player's intentions. Why? Because it is a man-made market. Obviously men are trading against the men. Then you know that the men have got the limitations and they have the limited money power. They will not be able to take the market to sky or to the deep sea. They have their limitations. So obviously once you understand the limitations, we can try to trade, understanding the limitations and understanding the intentions. So we need to identify the intentions. Okay, they are hidden agenda. We won't be knowing what they are going to do next. But knowingly or unknowingly, they make a false move before that intentional move. So if you track them carefully, we know which way the market is going to make a definite move. So the players make a definite move based on two conditions. One is where exactly the traders are holding unfavorable positions. Okay, whether the traders are holding lower level short positions after a gain, they are not doing the short covering. So when they are predominant in number, then they gain the levels and induce them to do the short covering. So we should be able to read beforehand and try to do a buy and sell trade and try to earn along with the other players. So before that, they will make a false move. So if they want to gain the levels, they will quickly drop and then rise. Whenever you come across a quick move in the market, understand they are all false moves. When they quickly drop, what is a hurry to drop? You know that just before the data, they made a very quick drop in the case of GBP. After one drop, they stopped cutting the low for more than 30 minutes and started gaining levels, and they had gone upward. So what was the necessity for them to make a very quick drop and then subsequently make a rise? They hit the stops of the long holders on the downside and then gain the level. So if you are identifying that false move, then obviously the intentional move you will be able to read and try to book profit. Trade along with them rather than breaking our head using various types of technical analysis and try to get confused. Rather than focusing on the market, we try to explore the possibilities. And when you look for the possibilities, obviously there will be two possibilities in the market. Market can go up or come down. And we have to get rid of that uncertainty. We go in for this sort of analysis only to get rid of the uncertainty. But unfortunately what happens, even though our best statistical calculations we use and try to derive out of that, the players know very well beforehand, okay, these are all the positions taken by the traders based on the statistical or the fundamental analysis, and they kept the stops here, then they try to hit it. Okay, you are smart enough, you are not keeping stop, fine. If predominant of the traders are not keeping the stop, then they make very quick extended upward stop and a downward stop and try to create the margins here. Okay, who is smart enough? So it is not that we are smart by not using the stop, but the players are much more smarter than us. They know how to handle our positions and how to induce us to liquidate the holding unfavorable position. So we need to identify the false moves and understand what is going to be their intentional move. So how exactly we can identify the false moves? So we need to know when they intend to make the false moves. So they intend to make the false move during the session start and the session end time, and before the data and after the data. In case if the traders are not taking positions after the data and they keep quiet after the data release, especially when you come across several data are going to be released. Say for example, BOE interest rate decision by 11 GMT, 11:40 GMT, 11:45 GMT, ECB is going to release. Then afterwards 12:30, you come across the ECB press conference. Then you find nearly about 1.5 to 2 hours. The traders are not willing to take positions. What is the big idea of making up and down moves in the market? They make a small reactions to the market as if the market is very sensitive to the data and subsequently keep quiet. Then after that ECB press release, then you find the last 30 minutes, you find the market is suddenly making upward or a downward move as a false move to start with, and then subsequently the intentional move. So when the traders wait for the market to settle down and try to take the positions, the players also willing to wait and let the traders take the positions and hit their stops, afterwards make their intentional move. So when you identify the false move, then during such false moves you try to take the positions, the players will not be hitting your stops. For that you need to trade along with that of the players. So what happens in the market? The players drop the market and buy and quickly rise the market and offload, distribute the position. I explained it earlier. So we need to identify the false move, which are very, very quick moves. So whenever quick move happens in the market, we try to watch it. And if you are not able to understand, just keep away from the market and just watch it theoretically. Okay, they made a false move. First of all, learn it properly. Okay, they made a false move, then subsequently they made the intentional move. Every time they do the same mechanism. Okay, next time when they make a false move, I'll see that they are not cutting the low for more than 30 minutes, then I'll try to take a buy then try to book profit during their intentional move. Then early or late session they make quick moves in the market. It can be a stop and or an extended stop and or a false move. I'll explain later on in my next webinar what are the type of moves they do in sequence and how exactly we will be able to identify, okay, this is the move they have done, next move is going to be this. That will give us the real focus. Okay. The early and the late sessions are 1.5 hours from the start of the session towards the close of the session. The session timings I have given it in the earlier webinar, like Japanese, European and US sessions and the gap times in between. Then I also explained there how exactly the early sessions and late sessions are to be identified. During such session times, early and the late sessions, they try to make that false move or the stop. So we should be able to identify them. So we need to track the intentions of the players. For that, we need to watch the market whenever it is near that of the low or near that of the high. When it is in the middle level, there is no need to watch. So that we need not watch the market 24 hours. Once in half an hour or once in 1 hour, you try to see whether the high has been altered or the low has been altered. Try to make a note of it from that of the live market code page. Whenever they are cut the high, just watch it for about 1 hour. And they come down after cutting the high and come below that of the earlier. Okay, they have made a stop and you identify. When they go up for 2 hours, identify they have made an extended move. So you will be able to identify the sequence of moves. I'll explain it in the next webinar how exactly we can track their intentions. Then follow the net change to understand the limitations. Read the remaining potencies in the market. Say for example, now Euro has made only 9 pips positive net change. GBP has made only 36 pips positive net change. So you find that market is really lackluster. They are making up and down moves in order to induce the lower level short sellers to do the short covering and the higher level long holders to hold it and later on come for long liquidation. So understand the limitations by taking into consideration their daily limitations like 150 pips in Euro. They can rise or drop Euro about 150 pips. GBP about 250 pips. Then 200 pips in the case of USD, USDCH, USD CAD. Then 100 pips in the case of Australian dollar on the upside or the downside. Whenever they have finished it, try to take the position. On the same day, you may not be able to book profit. Very next day, you should be able to make a definite profit. Then understand their weekly limitations in case if you want to do the position trade. 350 pips up and down, up or down move they can make in the case of Euro, 600 pips in the case of GBP. So whenever they make a 600 pips rise or a drop, don't think that they made a very big move and try to become bullish. Very next week they can drop it also. Then 450 pips in the case of USDN and USDCH. Then you come across similarly the market cycle, namely the monthly market cycle. So this on a monthly basis you need to understand. Month start of exactly they make the false move during the first week of the month and last week of the month. Then subsequent the other 2 months or the 3 months in a particular month they make the trending point. So then afterwards the next month they may continue the same trend. Then afterwards they try to reverse it because they don't continue the trend for a longer time. So you find that the traders create the market, players create the market sentiment and try to induce the herd of traders to follow it. And so we need to always keep in mind what appears in the market is not true because they are trying to create the sentiment and probably they are going to distribute the positions by holding high or drop the market and they are trying to buy from that of the traders when they are doing distress sell at the lowest level. So herd of traders are being induced and or they are being influenced by the sentiments and subsequently when they just make a big noise out of that as experienced traders, the newbie also try to follow. Later on find that I was following this particular person, it is not working. Then I followed this person, X, Y, Z, all those things, including me. Then finally they will say that no, none of the forecasts are working. Why? Because they fail to analyze on their own why they are not working and they fail to understand or fail to read the market by themselves. Instead they expect others to read the market. So a method which is suitable for me according to my usable margin, according to my trading style may not be usable or may not be workable for others. So we need to always assimilate the information from various analysts and try to build your own system. Then experienced traders normally talk about their success but not the failure. Including me, I don't disclose my failures and I don't disclose my weakness. That is a common human tendency. No? So you have to find out. We only come to know about the success. Immediately out of greed we try to follow it. Later on we face the failures and we simply keep quiet. Then look for another alternative analyst. So we have to come out of this and we have to find out, give equal importance to that of the success and the failure and find out how exactly the failure you can convert to a success. Then online attractions and distractions you come across because you know that various types of analysis are now available in websites free of cost. So which attracts many of the traders to search for various types of analysis and various types of auto trading, automatic analysis systems, etc. And you may go for it, but ultimately you have to understand when the market is so dynamic, a simple statistics cannot really understand it fully. Then you come across, when you go in for such type of analysis, invariably our mind gets distracted. And the social networking also invariably are distractions for that of the traders. Because you might be reading various types of analysis or you might be reading various types of trading styles of various other peoples, but it may not be suitable for you. But still, you can go through that and you have to derive your own system rather than blindly following any other system, including my system. Then tend to follow others only out of greed and panic. Because whenever you hold an unfavorable position, you try to look for a person who is giving a focus similar to our ideas. Then you stick to him and say that you are a great person because you are telling that euro is going to drop. When it is not dropped, then you start yelling at that person and telling that because of you I was holding that euro short position, otherwise I would have just booked a nominal loss. This is a normal tendency of the traders. Similarly, when the position is making very good profit, then out of greed you try to follow. Somebody is telling that euro is going to go up, and later on you find that when it reverses quickly and the position starts making loss, then you start yelling. That is why you find all the analysts are using the discline. Because out of greed and the panicness, you try to imagine so many things and finally you try to avoid taking the appropriate level, the profit, then subsequently it becomes a failure trade. So develop your own trading style which is suitable for you. And so I explained to you in the market reading a very simple technique, that is identify the false moves in the market which are quick moves. Then you will be able to see the next move will be the opposite move, which is intentional move. So these are all the only two things one need to understand. Then next webinar, tomorrow's webinar, I'll explain to you how to identify the false move, how to identify the different type of move, then how we can take our trading decisions so easily from time to time, and what are the different types of trades we can probably follow depending upon the varied market conditions. So I take this opportunity to thank everybody. I don't know whether I have the time to answer to the questions which are asked here. Let me just try. Minimize the PowerPoint presentation and focus the camera over that of the live market code page. Sorry for the hotcom interruptions, because of that I lost some time. Otherwise, I would have given more time for questions. Okay, not many questions. Then draft from dive. Okay, Raj, technical analysis invented by the players for the traders so that they were, no, this is wrong, because technical analysis or the type of analysis which can really work if the market is not being manipulated. And whenever you come across the artificial rigging happening in the market, only then you come across the failures in technical analysis. When you said they are all signs, statistics is signs, please understand, irrespective of time frame it works. But when there is a rigging happening in the market, you come across the failures, the limitations. That is why you try to identify the level of error and the probabilities in technical analysis. But we can identify, okay, it is 90% success. That this particular analysis is 90% success. But in case if our trade falls in the 10% failure, then we incur loss. So we have to find a system which is 100% foolproof. So I will try to induce you to derive it in the next webinar. Until it. When you set false move at start of the session, it is the gap time prior to start. No, gap time also they make the false move. On the first 30 minutes they make that stop. I'll explain this sequence in the next webinar so that you will be able to understand. I only given the trigger now. The next webinar I'll try to give that answer for it, because I cannot finish everything in 45 minutes. In Fernando, understanding but do not agree. Okay. For weekly change, start of the week 0, 2, 3, and 330 levels. No, the week I have given the timings of the market. Please go to that of the timings of the market and you will be able to understand it, please. The webinars are being recorded and you can go through that and understand the timing. If still you have the questions, you can ask me. Then the JBP sweep of the high, a false move. Yeah, it is a stop point. And would you elaborate on a monthly? Yeah, I will explain the monthly cycle once I explain the different types of moves. Then also I'll explain how exactly the prime numbers take an important role in the monthly market cycle. Okay, so I finished the questions here. So let me focus the camera on that of the slide. So I take this opportunity to thank FX Street and also the participants for your valuable time in understanding the market and really addressing the systemic problem we come across in market reading. So we have to develop a dynamic reading system so that we'll be able to read the intentions of the market or the players from time to time and try to decide upon the trades. If you are already holding a unfavorable position, we should also be in a position to exit out of that when you are able to make that reading that the market has gone against us. So limiting the risk and also do a successful trade, we need to have the perfect market reading and the forecast. So it is not that I give the forecast, you follow it. You should be able to give the forecast on your own, at least on the intraday basis. So next webinar tomorrow between 12:30 and 13:15 GMT, I will just give you the ideas how exactly you can develop the forecast of your own. So I thank once again and see you tomorrow during the Asian session, live market analysis webinar, and followed by that, the My Trading System webinar 6. Thank you one and all. See you.